You've been using a bank your whole adult life. You trust it. You barely think about it. The app works, the card works, the money goes in and comes out. The relationship is so ordinary, it's become invisible, which is exactly how they prefer it. Because the banking system you interact with every single day contains a set of mechanics, structures, and quiet revenue streams that most customers never look at clearly. Not because they're hidden in the illegal sense. Everything is technically disclosed somewhere, in language designed to be skipped, but because the less you understand about how your bank actually makes money, the more of yours it gets to keep. This video is 10 facts about banks that most people don't know, and, more importantly, what each one is quietly costing you. Banks are not neutral infrastructure. They're businesses, highly profitable ones, and the product they're selling, in almost every case, is your money. Specifically, the gap between what they pay you to hold it and what they earn by deploying it elsewhere. Understanding that basic dynamic doesn't make banks villains. It makes them legible. And legible systems are ones you can navigate deliberately, rather than just inhabit passively. Most people interact with their bank, the way they interact with the weather, as something that happens to them rather than something they can make choices about. These 10 facts are about changing that, about seeing the structure clearly enough to make it work for you rather than quietly against you. The first fact is the one that underpins almost everything else. Banks don't actually hold most of your money. They lend it out. When you deposit $10,000, the bank is legally required to keep only a fraction of that in reserve. The rest gets lent to other customers as mortgages, car loans, business credit. Your deposit becomes their inventory. They pay you a modest interest rate for the privilege of using it, then charge borrowers a significantly higher rate. The spread between those two numbers is one of the most consistent profit engines in the financial world. The second fact follows directly from the first. The interest rate your savings account pays has almost nothing to do with what's fair and almost everything to do with what the bank can get away with. Standard savings accounts at major banks frequently pay interest rates well below what's available at online banks or credit unions offering the same deposit insurance and the same accessibility. The difference isn't about risk, it's about inertia. Banks know most customers won't move, so the rate offered to inactive customers doesn't need to be competitive. Moving to a higher yield account at a comparable institution is often one of the simplest, lowest effort financial improvements available, and most people never make it. The third fact is about overdraft fees. They're one of the most profitable products banks offer, and they're disproportionately paid by the customers who can least afford them. The structure is straightforward. A transaction processes when the balance is insufficient, the bank covers it and charges a fee, often between $25 and $35. Multiple transactions in a single day can result in multiple fees. Research has consistently shown that a significant portion of overdraft revenue comes from a small percentage of customers, typically lower income account holders, who trigger fees repeatedly. Opting out of overdraft coverage entirely means transactions simply decline when funds are insufficient, which is inconvenient but significantly cheaper. The fourth fact is about the order in which banks process transactions. Many institutions, historically, have processed transactions from largest to smallest, rather than chronologically, a practice that maximizes the number of overdraft fees generated when a balance is low. Regulatory pressure has reduced this in some markets, but the practice hasn't disappeared entirely. Knowing how your specific bank orders transactions is worth understanding. The fifth fact is that your credit card's grace period is a genuine financial tool that most people don't use deliberately. If you pay the full balance before the statement due date, you pay zero interest. You've effectively borrowed money for free for 30 to 55 days. The card becomes a cash flow management tool rather than a debt instrument. The moment you carry a balance, the grace period disappears and interest accrues from the date of each purchase, not the statement date. Two completely different financial products, identical card. The sixth fact is about the true cost of minimum payments. A $3,000 credit card balance at 20% interest, paid at the minimum each month, takes over a decade to clear and costs more in interest than the original balance. The minimum payment is designed to maximize the interest paid over time, not to help customers become debt-free efficiently. The seventh fact is that banks sell financial products, insurance, investment accounts, loan products, through advisors who are often incentivized to recommend what's profitable for the bank rather than optimal for the customer. This isn't universal, and many bank advisors are genuinely helpful, but the structure of compensation matters. Understanding whether someone giving financial guidance is operating as a fiduciary, legally required to act in your interest, or simply as a product salesperson changes how you evaluate their recommendations. The eighth fact is that joint accounts carry more complexity than most people opening them realize. Either party can typically withdraw the full balance without the other's consent. The account may be subject to the debts and legal judgments of either holder. Understanding the legal structure of a joint account before opening one is worth the conversation. The shift here isn't cynicism about banks, it's clarity about what they are. Banks provide genuinely valuable services: the payment infrastructure, the deposit insurance, the access to credit. These matter. But a bank relationship, like any financial relationship, should be evaluated periodically on its actual terms. What rate is being paid on deposits? What fees are being charged and for what? What products are being offered and by whom? Under what incentive structure? These aren't hostile questions. They're the questions any financially aware adult should be able to answer about the institution holding their money. And most people can't, not because they're incurious, but because the bank's design has never particularly encouraged them to ask. The practical response to all of this is a 10-minute audit of your current banking relationship, done once. What interest rate is your savings account currently paying? Look it up. Then look up what a high-yield savings account at an online bank is currently offering. If the gap is more than 1 percentage point, the cost of inertia is real and calculable. Are you paying any recurring monthly fees on your checking account? Many banks waive these fees under specific conditions: minimum balance, direct deposit, student status. Understanding exactly what you're paying and whether it's avoidable takes one conversation or one look at the fee schedule. Do you have overdraft protection enabled? If so, understand exactly how it works and what it costs. For many people, opting out and simply letting transactions decline is both cheaper and clearer. And finally, when did you last actively choose this bank? If the honest answer is that you've never actively chosen it, just inherited or defaulted into it, that's the signal that a 15-minute comparison of alternatives is worth your time. Not a commitment to change, just the information required to decide whether staying is a choice or just an assumption. Banks aren't adversaries, but they're not neutral either. They're businesses operating in their own interest within a system that rewards customer passivity and charges for it quietly and consistently over time. Understanding how that system works doesn't require becoming an expert. It requires knowing enough to ask the right questions about rates, fees, products, and whether the relationship you're in is one you'd choose again, with everything you now know. Most of the time, a few small adjustments to how you use the banking system are worth more than any dramatic financial overhaul. The money you keep by understanding the rules is money that goes somewhere better. That's not complicated. It's just worth knowing.